Welcome back to the Pro Ticker Podcast, your Tuesday morning edition covering major financial magazine headlines, everyone.
Good morning.
We've got quite a collection of articles today. We're really digging into, well, the market reactions to all this tariff talk, potential and actual.
Yeah, and how that feeds into earnings, especially for the banks, it looks like.
Exactly. And then there are these broader economic signals, investor sentiment. It's all connected.
It really is.
So our aim, like always, is to sift through these headlines, pull out the key insights, and, make sense of it all without getting buried in jargon.
Sounds good. It's definitely a complex picture right now. You see trade policy effects popping up everywhere.
Okay, let's jump right into the tariff situation then. It seems to be the main thread today, starting with luxury goods, that Market Watch piece on LVMH.
Right. Analysts were worried about U.S. tariffs, but it's China that drags LVMH. Quite revealing.
Yeah, what jumped out immediately was the hit to LVMH, a giant like that.
It's fascinating, isn't it, how even these massive global brands are, well, vulnerable to demand shifts in places like China.
So the article mentioned their first quarter sales growth really stumbled.
Yeah, organic sales growth down 3%. And the big one, sales in Asia, excluding Japan, dropped 11%.
11%, wow.
And it wasn't just tariffs, apparently. A Chinese consumer slowdown seems key, even hitting Japanese tourism, fewer Chinese visitors.
And that 5% drop in fashion and leather goods, that's their core, right?
Pretty much. A big miss. And MarketWatch said it really spooked the luxury sector. LVMH stock dropped 8%.
Yep, 8%. And get this, it put their market cap basically level with Hermes.
Ouch.
We saw Burberry and Brunello Cucinelli dip too. Shows that contagion effect.
Definitely. Deutsche Bank analysts apparently called the figures below the lowest expectations. It just highlights how tied they are to Chinese spending.
So a key takeaway there is looking beyond just tariffs, right?
Mm-hmm.
Macro trends in key markets matter hugely.
Absolutely. Crucial point.
Now, the article did mention a small pickup in U.S. demand for LVMH stuff. Fashion. Watches. Right before tariff news hit.
Oh, interesting. Like people were trying to buy ahead.
Maybe, and LVMH talked about different price hikes for different brands and pointed to their 3 U.S. factories.
Ah, okay. So they're trying to be strategic. U.S. production helps shield them a bit, and brand-by-brand pricing is, well, smarter than a blanket hike.
Makes sense. Okay, speaking of tariffs, the EU got that 90-day pause on the 20% reciprocal ones, but the 10% universal one is still on.
Right.
Which brings us to Apple, another Market Watch article. Apple hasn't gotten an all clear on tariffs, but its stock is still rising. Very different reaction compared to luxury.
Yeah, that 2.2% stock gain for Apple. It seems mostly down to that customs guidance,
Yeah.
exempting smartphones, laptops from those reciprocal China tariffs.
Huge relief for Apple investors, I bet. Thinking about iPhone and MacBook prices.
Definitely. But the article throws some cold water on that, too.
So
Well, Commerce Secretary Lutnick hinted at other tech tariffs being planned, and apparently Trump himself denied broad exemptions. So, still murky.
Okay. So maybe not an all clear at all.
Not quite. And Laura Martin, the Needham analyst in the piece, makes a critical point. Over 80% of Apple's stuff is made in China.
Right. Moving that'd be massive. Expensive, too.
Exactly. Years, probably. Huge cost difference with U.S. labor. So they dodged this tariff, maybe, but the basic risk tied to China manufacturing, still there.
And it's not just tariffs on the finished phone, is it? Martin mentioned higher component costs, supply chain disruptions.
Yeah, pressure on free cash flow. And did you see that bid about flying over 1 million iPhones from India to the U.S.?
Whoa, really? To beat potential tariffs?
Presumably. Shows the kind of extreme measures they're taking.
Wow. So even with the improved outlook from Ben Reitzes at Melius Research, he still sees risks from Lutnick's comments.
Right. And Reitzes has suggested Apple might need to up its U.S. investment, like way beyond the $500 billion they already pledged, maybe, to really avoid tariffs.
That's a huge number.
It is. And Reitzes has also floated the idea that maybe March and April sales surged pre-tariff fears. And now we might see a slowdown.
Ah, that makes sense. Pulling demand forward because of the uncertainty makes forecasting a nightmare, I imagine.
Totally. Behavioral economics right there. The threat of higher prices changes buying habits.
Okay, let's shift gears. Another sector feeling the heat. Aerospace. That Bloomberg piece, the latest tariff fallout, China reportedly tells its airlines not to take any more Boeing planes.
Oof. Yeah, that sounds like a pretty direct shot in the trade fight.
China telling airlines, stop taking Boeing deliveries. jets, parts, everything.
That's what Bloomberg reported, and the market reacted instantly. Boeing down 3% pre-market, Airbus up.
Tells you what the market thinks. And those 10 undelivered 737 MAXs for China, now uncertain.
Adds another layer of worry, doesn't it? Seems like clear retaliation in the bigger trade picture.
And you mentioned connecting this to the other Bloomberg piece about the 145% tariffs already on some Chinese goods.
Exactly. This Boeing news has to be seen in that context. It's part of that ongoing tit for tat.
Okay, so tariffs casting a really long shadow. But let's pivot to banks now. A couple of Wall Street Journal articles here. Seems like maybe counterintuitively they're benefiting.
It's a bit of a paradox, isn't it?
Let's start with Goldman Sachs Q1 earnings. Profit surges powered by trading revenue.
Right. Goldman's profit up 15% in Q1. And the driver. Record revenue in equities trading and lending.
Driven by investor uncertainty about Trump's policies.
That's what the article suggests. The volatility creates trading opportunities.
And it was a big jump, right? Equities business revenue up 27%, especially derivatives.
Huge jump. Shows investors are actively repositioning using complex tools to navigate this choppy environment.
Goldman CEO David Solomon mentioned recession risk increasing.
Yeah, concern about slowing global growth. But that very uncertainty, it keeps the trading desks busy.
The article also noted a shift away from American exceptionalism trades towards international assets.
Another sign of repositioning, seeking different exposures.
But investment banking was down for Goldman. M&A advisory fees dropped.
Yeah, down 8% overall, advisory fees down 22%, but their deal backlog increased.
So deal-making paused, maybe waiting for clarity.
Seems likely. Companies get cautious about big deals in uncertain times. The backlog suggests appetite is there, but timing is everything.
And this trading boom wasn't just Goldman. The other WSJ piece, Trump's tariff chaos fuels Q1 trading revenue for Goldman, JP Morgan. Says Morgan Stanley saw it too.
Yes, exactly. Goldman, JP Morgan, and Morgan Stanley all saw trading revenue surge, higher even than during the COVID peak.
Wow. Combined, over $12 billion just from equities for those three.
Incredible number. Solomon said client activity remains high. Investors keep shifting positions due to the uncertainty.
And the article mentioned Treasury volatility, high currency trading volumes.
Yeah, the whole system's churning. The key insight is, while tariffs hurt many sectors, they can create this, well, profitable churn for big banks' trading arms.
That shift out of U.S. exposure into international assets seems like a major driver.
Definitely fueling trading volumes. And the numbers were stark. JP Morgan equities trading up 48%, Morgan Stanley up 45%.
Morgan Stanley CEO Ted Pick talked about animal spirits, trying not to get caught offside.
Captures it well, doesn't it? That fear of missing out or fear of big losses driving activity can make swings bigger sometimes.
But maybe there's some confidence in the banks. That MarketWatch piece, fresh debt from JP Morgan, Morgan Stanley draws warm reception.
Yeah, the bond issuance. That's an interesting counterpoint.
Successful bond sales by JP Morgan, Morgan Stanley, BNY Mellon, strong demand, narrowing yield spreads versus treasuries.
Right. That suggests investors see these big banks as relatively stable, maybe even a haven amidst the tariff uncertainty. Narrowing spreads mean lower perceived risks.
And the article noted the big bank stocks were actually up on Monday, before BofA Citi reported.
So yeah, some market confidence in their resilience, maybe betting they'll keep benefiting from trading, act as a buffer, but still vulnerable in a deep downturn, of course.
Okay, let's zoom out. Broader economic concerns, investor sentiment. That Bloomberg article. Investors haven't been this bearish in 30 years, BofA poll shows. Sounds grim.
It's a really striking headline, isn't it? Sentiment on the economy, most negative in 3 decades. 82% of fund managers expecting global weakening. That's quite something.
And it's translating into action. Record numbers planning to cut U.S. equity exposure. Net 36% underweight U.S. stocks in April.
That's a huge swing. From overweight to underweight in just 2 months. Really shows the depth of concern about U.S. trade policy impact. And 42% think a U.S. recession is likely.
The BofA strategist even said peak fear might not be fully priced in yet, implying investors could get even more cautious.
Potentially. More cash hoarding, less risk appetite.
Yeah.
Definitely a signal to watch.
So how might the government respond? The Bloomberg piece on Fed Governor Waller. Fed's Waller says interest rates may need to be cut soon if largest Trump tariffs stay in place.
Yeah, Waller's comments were pretty direct. He's saying if these big tariffs stick, the economic slowdown could be bad enough for the Fed to cut rates.
Even if inflation spikes temporarily, like up to 5% core PCE.
That's what he suggested. The argument being, in a big slowdown, Recession risk outweighs a temporary inflation bump. Shows the Fed is watching the trade fallout very closely.
He laid out two scenarios, right? Current 25% average tariff versus a drop to 10%.
Exactly. And under the lower tariff scenario, he implies the Fed could wait longer on cuts, maybe later in the year. Directly links trade policy to monetary policy thinking.
Okay, now, despite some up days in the market, we're seeing technical warning signs. The MarketWatch article on the S&P 500's death cross.
Ah, the death cross. Sounds dramatic, doesn't it? It's when the 50-day moving average drops below the 200-day.
A potential sign of a downtrend. And the Russell 2000 and Tesla showed it too.
Yes, technical analysts definitely watch that. But the article rightly points out the history is mixed.
Declines often follow, but may be short-lived. S&P often higher months later.
Exactly. Paul Ciana at BofA Securities noted, you really need to watch if the 200-day average itself is falling. And Craig Johnson at Piper Sandler sees them as lagging indicators, maybe signaling a snapback rally is coming.
And recent examples are all over the place. Down a year after the March 2022 cross, but way up after March 2020.
Right. Shows you can't rely on just one indicator. It's complicated.
Adding to market weirdness, Bloomberg's Treasuries stall, with 10-year term premium reaching decade high. What's going on there?
The term premium, that's the extra yield for holding longer bonds. It's at its highest since 2014. Bloomberg says it suggests growing uncertainty about the long-term economy and U.S. policy.
Ed Yardeni thinks it's fundamental concerns driving yields, deficits, policy uncertainty, not just market jitters.
That's his take. Deeper worries about the underlying fiscal situation.
And Treasuries, the usual safe haven, sold off last week, questioning their role.
Yeah, that dented confidence. Benoit Ann at MFS said investor confidence in U.S. assets was meaningfully dented. Treasuries maybe lost some defensive quality temporarily. That's significant.
And finally, on market dynamics, zero-day options. Bloomberg's zero-day options, 0DTE, show how VIX undersells Trump tariff turmoil.
Right, those super short-term options expiring within 24 hours. Trading volume is way up.
A sign of turbulence. And the article says a measure of that one-day volatility is actually higher than the VIX.
Yeah, suggesting the VIX isn't capturing the full extent of this extreme intraday volatility, which is likely driven by tariff news hitting so fast.
And there's a debate. Is it the 0DTE options themselves causing swings or just reacting to tariff news?
Probably both, right? A feedback loop. Tariff uncertainty creates volatility, and 0DTEs amplify it as traders jump in. Research suggests 0DTEs have coincided with higher intraday volatility.
Let's quickly touch on some other developments. Bloomberg. Trump tariffs. Probes of chip, pharmaceutical imports started. Looks like the trade war could broaden.
Yeah, these Commerce Department probes into semiconductors and pharma imports, national security angle, could lead to more tariffs, big potential impact on Apple, Nvidia, drug companies, supply chains, costs.
Then, market watch on Intel. Intel's new CEO isn't wasting time. They sold a chunk of their Altera business.
51% stake to Silver Lake. Valued Altera less than Intel paid, but analysts see it positively. New CEO making moves, focusing the company, new leadership at Altera too.
And Netflix setting huge goals. Wall Street Journal exclusive, aiming for a $1 trillion market cap, doubling revenue by 2030.
Very ambitious. Big targets for ad sales, operating income, and focusing on overseas growth, India, Brazil. They think streaming might hold up okay in a recession if people stay home more. Interesting bet.
Then the Meta antitrust trial starting. Wall Street Journal. Will Meta have to give up Instagram? Huge implications.
Massive. FTC says Meta's a monopolist, bought Instagram and WhatsApp to kill competition. Meta says it competes with TikTok, YouTube. Polls suggest many people do see Meta as a monopoly. Losing Instagram and WhatsApp would be enormous for them.
Shifting to personal finance. Market watch on the retirement magic number. It's actually lower this year.
Slightly lower, yeah. $1.26 million now. Maybe easing inflation helped perceptions, but still a huge number for most.
And the gap between savings and goals is widening. Lots of worry about outliving savings, especially for Gen X.
Exactly. And ongoing worries about Social Security, inflation eating away at savings, persistent concerns.
And quickly, Bitcoin. Bloomberg says Michael Saylor's strategy bought more Bitcoin during the volatile week.
Yep, another $285.8 million worth. Taking advantage of swings. They now hold around 2.5% of all Bitcoin expected to exist. Huge bet. Expecting an unrealized loss in Q1, though, due to accounting changes. But their stocks soared since 2020.
Okay, so wrapping up this deep dive, it feels like tariff uncertainty is really the main character right now, doesn't it? Affecting everything from luxury to tech to aerospace, fueling bank trading.
Absolutely. It's casting a long shadow, contributing to investor caution, making the Fed think about rate cuts. It's all interconnected. The market's constantly adjusting.
A really complex web. So the final thought for everyone listening today is, how might all these moving parts, trade, earnings, sentiment, policy shifts, actually impact your own financial plans and outlook? Something to chew on.
Definitely. Understanding these bigger forces is key to navigating your own situation.
All right, that's all the time we have for our deep dive today. We'll see you all tomorrow morning with new headlines from major financial magazines.